Hey there, it's Mike Langford. Welcome to another episode of the Modern Financial Advisor Podcast. On this episode of the show, Arnim Holzer, Global Macro Strategist at Easterly EAB, is with me for an incredibly well-timed conversation about market volatility. Arnim says that many of the fundamentals that financial advisors have used for generations for creating their asset allocation models may be flawed. What implications might this have for your clients and your firm? And what's behind Arnim's conviction that financial advisors should be taking a different approach given the current macroeconomic environment? Let's find out. Now, before we do that, please do make sure you take a moment to subscribe to the Modern Financial Advisor podcast on Apple Podcasts, Spotify, Google Play, Amazon, the YouTubes, or wherever you like to get your podcast jam on. And if you have a question or a suggestion for a topic or a guest for the show, hit me up. I'm basically at Mike Langford everywhere on the internet, or you can shoot us an email, podcast@finservmarketing.com. Okay, let's get to the conversation with Arnim Holzer. Well, Arnim Holzer, so wonderful to see you. Welcome to the Modern Financial Advisor podcast.
Great to be here. Thanks for having me on.
My pleasure. My pleasure. I was mentioning earlier, we're in Friday mode, which is a fantastic way to be. Friday zone, I think everybody feels a little bit better. You don't like to live your life for the weekends, but you know what? They do feel good, right? So any big plans for you and the fam for the weekend?
I think my wife and I are going to hit Central Park and maybe some museums and do a little shopping.
That's pretty awesome. I don't think my weekend is going to be as active as that. I think maybe a little stuff around the house, and then I don't know, maybe my wife and I have been dying to get out to a movie, and because of lately the movies have just stunk, and we're rediscovering, we're kind of entering that pre-empty nester zone. My daughter is a 16-year-old in high school, and you're getting towards the time where, like, you know what? We get to go on date nights like whenever we want to and stuff like that. So we're getting back into movies is one of the things we used to do when we were younger. So hopefully everything goes smoothly. Great. Find something to watch. All right, man. So let's get into it. Before we click the record button here, you were talking about how it's a great time to have the conversation we're about to have. You're like, volatility is here, baby. This is why we do the things we do. So I want to dive into why this conversation is going to be a lot of fun. So we're going to be talking a lot about some challenging of the asset allocation frameworks that advisors and wealth management firms have been using for decades. And what I love about this is you were like the third person I've had on the show recently that is bringing forth some challenges about some of the common ways that advisors and firms have been constructing portfolios for the clients. So let's get started by maybe going back to the beginning. What are some of the traditional asset allocation models that we were taught, and why is that model fundamentally outdated in your mind?
Well, I think this goes back to the 1950s. 1952, modern portfolio theory was put forth by Markowitz, and frankly, I don't want to besmirch Nobel Prize winning work, but it was groundbreaking. But it had to be simplified because some of the computational abilities and some of the understanding of the way assets worked against each other, in other words, a correlation of assets, was minimized to really focus on volatility efficiency, return over the volatility, which was looked at as standard deviation. And that approach, frankly, was groundbreaking. But some of the details and some of the assumptions there were really much more important than I think anyone understood at the time. But as commercial application often does with scientific achievement, some of that work was simplified to make it commercial. And I think a lot was lost in the sauce, Mike.
Oh, interesting. I love lost in the sauce. It's usually a basketball term in my household. Like, oh, you got lost in the sauce. So what do you mean? So what do you think? Like, if you had to pick a couple of things that you think were oversimplified, what were those things? And so that our audience is financial advisors. I say this almost every episode. Many of the financial advisors working today got their start as stockbrokers, right? So they got licensed to sell products, stocks, bonds, and mutual funds, in some cases, insurance. And so that's where their knowledge base is. And so much of what they're doing is selling product effectively. And then once we transform those people as stockbrokers into financial advisors and expected them to be more holistic and comprehensive about the way they advise their clients, they still kind of sell packages, right? If you will, off-the-shelf packages of investment products, off-the-shelf packages of financial plans. Like, here's a model portfolio. Here's some common things we do to plan for. So so that the average advisor can understand that, because many of them weren't finance majors, weren't economics majors, right?
Right.
Economists. What do you think was oversimplified so that it could be packaged and delivered to a consumer audience?
Well, first of all, that's a really great background and backdrop. And I think to a certain extent, what happened is the boogeyman was made to be fees, right? Okay. Fees are too high. If we reduce fees, we improve average annual returns just because we reduce fees. And since everything includes a fee, basically, unless you buy the stock yourself, that was the way the industry went. And that was a legitimate thing to look at. The problem is, by making fees the exclusive issue for returns and really not understanding that some of the underlying assumptions around modern portfolio theory and these models that firms use to do long-term asset allocation and also to some extent technical asset allocation, you created a risk that correlations within assets were not well understood. And so most of these models, whether you use modern portfolio theory or the things that came after postmodern portfolio theory, Black Litterman, et cetera, for institutional folks who deal with more sophisticated versions of asset allocation, is the flaw that, correlations are not stable, actually. The correlations have a tendency to be unstable, Mike, and actually really unstable when you actually need them to be stable. In other words, when you need diversification to work and bring resilience, they're actually unstable. So the idea of optimizing to volatility still leaves you vulnerable to volatility, because when volatility spikes, it has a tendency to move correlations very powerfully in the wrong direction. The second part is really this idea that these numbers, these relationships of assets and the relationship of returns of assets are very stable over long periods of time. And actually what we're learning is they're much more regime oriented. In other words, when you look at the period post-Volcker, where inflation was super, super high, and I'm old enough to remember those days, you created a very positive regime for fixed income returns. So if you were going to look at asset allocation and diversification and just say, oh, fixed income is always a great diversifier, it's somewhat impacted by your regime. And then the third issue is really this idea that in modern portfolio theory, that statistical normality, statisticians would understand this, it's a Gaussian assumption, that you can normalize the expectations around different asset classes. Well, we know that in difficult environments where volatility rises, in fact, tails do enter into reality. And so those three assumptions, those three facts, mean that models are likely to not be particularly valuable in periods of stress. And those periods can last longer than what people think, oh, it's just a 3-month period in the middle of a 3 to 5 year cycle. Those periods can be disjointed for much longer and affect longer term asset allocation returns than people had understood. And so that's the message that we've been working on, that we actually did, our products and our approach is designed to overcome.
I like that. I like the fact that the model, as good as you designed it, is always going to break at some point in time, right? There's no such. It's what is it? There's a couple of ways of saying this we've heard in history. Every battle, your battle plan or a strategy for battle is only valid until it meets the first shots are fired or whatever. It hits the battlefield, and then everything goes out the window. Mike Tyson used to famously say, everybody's going to play it until they get punched in the mouth, and then the plan goes out the window, type of thing. And we've seen it famously, and I wish I could recall, maybe you do, because you're much more in this than I, but we have seen it famously where people are creating, what we call black box models, where they're out there doing these algorithmic trading. And it's based on a whole bunch of assumptions that a human being put in there. And all of a sudden something goes wrong, and that algorithm has no idea how to handle it. And it, trades itself into oblivion. We've seen a couple of shops, prop shops go out of business that way and so forth. So another thing you said, and I want to get back into this correlation thing. Like, so what's kind of not working well, but I love that you said, for a long time, the boogeyman was fees. In fact, for my entire career, I started in this industry in the mid 90s. Graduated college and really started immediately right into this industry. And it was fees. We used to have, full service brokerage. We had those fees back in the day. And then we had load funds. Those were really popular and so forth. But Vanguard and the others attacked, brought fees down. We saw active trading fees, for stock trading fees come down to zero, right? Most recently. The other thing, and I'm interested to get your take on this, if it works naturally in there, that we saw was an attack on active managed portfolios in favor of passive management, right? I used to work for State Street, and I'm blanking on his name, but the former head of SSGA, used to say, active is attractive, but passive is massive, baby. Passive from a business perspective. Yeah, we don't make a lot of money on these passive, but it's really easy to sell. And so the industry has been banging on this notion that look, you just can't beat the market. So why try? So let's go passive. But I don't think that invalidates anything you said, but I just kind of wanted to,
That's a great, first of all, these are really great conversations, and I'm so glad that we have a long format because, for your listeners, when you actually look at the data, and I would recommend that advisors go look at the data. And if you look at the average 60-40 fund, you should be earning somewhere between a 6 and 8% average annual return. If equities earn somewhere between, an 8 and 10% average annual return, if you take 3, 5, 10-year bases. And what you find actually in the last 15 years is that really hasn't occurred. And it's not because of fees, because you can construct these indices, Mike, you can actually construct them using passive benchmarks.
Right.
And what you find is that you have an equity correlation problem. And that is that all of these 60-40 funds, and by the way, the problem works with anything that's 50-50, 60-40, 80-20, because there is a very large correlation to equity across multiple asset classes. And even if you look at corporate fixed income, even if you look at high yield fixed income, there is a component of correlation to equity. And what that means is under normal environments, you probably get the return and the risk you're supposed to get based on the allocation. But when you move outside of the 1-2 standard deviation range of returns, we know the correlation starts to spike towards -1 and 1, which effectively means that you may think you own a fixed income instrument that has some component of fixed income duration kind of value and coupon. But the problem is the equity correlation inside that instrument, because not everybody owns treasuries in their fixed income, because for years they didn't get enough returns, so they were cheating out the credit curve. Well, what happens is that credit curve has correlation to equity. And so there is a danger of having much more correlation to equity than you really understand. And so the problem with the 60-40 was that actually the correlations to equity were between 80 to 90%, which obviously when you went into a beta event, it became a downside problem for you. And so the argument that I make, and I think you and I talked about this before, is there's really no other industry that I know where the difference between your expected forecast of performance and your realized performance is as wide as it is in asset allocation models. And I would posit it's not because the modelers are bad. They're very good mathematicians. They try to put in, alternatives. They try to put in, different kinds of funds to add to the resiliency of their portfolios. But the problem is they're still trying to optimize to a volatility number that's over time averaged, average returns and average volatility. They're using past returns to determine where they think these portfolios should be allocated. They're not using the danger of correlation breakdown. And this is not so dissimilar, and we talked about this, to what Nicholas Copernicus did, in the 15th century, going to all the mathematicians of his time and said, you have a problem with your calculations because you have to basically have planets go backwards and stars go backwards, retrogression, in order to make this process foot, to make it work. And I see a similarity here in that if you just give up the correlation is stable assumption and say we need to build into our portfolios assets that in drawdown environments and equity decline environments lose correlation and increase correlation to volatility, if you add those kind of products in, all of a sudden what happens is the models, you don't have to be as good a mathematician. You don't have to be as complex in your asset allocations because you've recognized that in this case, in the Copernicus case, that the sun is the center of our solar system, not the earth.
This is so awesome. We're totally nerding out here. I like it. Let's break it down a little simpler for the advisor. I'll tell you why I like to break it down simple. Advisors are incredibly smart, right? They're all doing great, especially if they're watching the show. They're the best advisors, to be honest with you. But they are the smartest advisors. No, but the reason why I always like to break things down super simple is I like to give the advisor firepower so they can explain it to their client who has, no understanding of like how this type of thing works, right? So let's get down into like why the correlation is so strong between equity and corporate bonds. Like why is that correlation there? Because I don't think a lot of people actually understand why from a business perspective. Right. Like, okay, so I understand it, like my business capitalization structure is going to be equity, right? And it's going to be some debt, right? So I get it. So that's how I've capitalized my business.
Right.
I've got stockholders and I've got bondholders. I have debt holders. Why are those things? Why is there a stronger correlation there than people would think? It's just because of the performance of the business? Is it that simple, or?
There's a couple of reasons. First of all, you have macro and you have micro. You also have tactical, what's happening in the market right now versus what's happened in years past. From a macro point of view, the Fed policy around the yield curve, the Fed policy on short-term interest rates can have an impact on the shape of the yield curve, whether it's steep or whether it's flat or inverted. So you have the Fed policy that's going to determine the capital market structure. Obviously, if businesses are going well, the Fed is going to be able to keep a relatively positively sloped curve. And that allows you to believe if things aren't going to go well, that the Fed can then lower rates. So there is a belief that at least Treasury rates and the cost of borrowing can provide some defense for you, because if you own bonds and they lower interest rates, clearly your bond portfolio is going to give you some defense, and companies are going to be able to refinance cheaper. So there's a very stable long-term view, and that occurs primarily in environments where the Fed is engaged in managing inflation within a reasonable bound. So if the market believes inflation is relatively well contained, or at least within a tight range, they have faith in the Fed. And that goes both ways. That also means that if things are too strong economically, that there's a likelihood the Fed's going to raise rates, which is going to mute activity. Your bonds may go down, but it's a symptom of activity being very strong, which means your equities are going to be obviously doing relatively well. Right. And there's a long-term cycle, or is in baseball parlance, are you in the first 3 innings of a game, or are you in the last 3 innings of the game? And that's a macro cycle issue, which has historically legitimized the idea of owning bonds and stocks. The difficulty with that point of view, Mike, is that ultimately you have to believe that the inflation boogeyman, that the inflation regime is relatively well contained and within a range that gives you confidence in the Fed. From a tactical point of view, we've just come out of a period where inflation, in fact, wasn't transitory, where expectations became ingrained. And there's still some concern around portions of the inflation construct. And certainly with tariffs, I'm not totally convinced that tariffs are going to blow out inflation terribly, but there are legitimate concerns, which means that the Fed's control of the inflation scenario and of rates may not be as correlated as it traditionally is under the normal regime, which means bonds and stocks, that treasuries, that the negative correlation you'd like to see isn't as strong as it was. And in fact, for much of the last 2 years, you saw positive correlation. So what was good for bonds was good for stocks. And that's actually not great for diversification. The other issue that you deal with is this idea that equities, particularly corporate equities and high yield, were very historically have been if fundamentals are strong, then you worry that there's going to be a raise in rates. Yeah. We just came out of a pandemic period. Remember when the Fed basically said all bonds are good, we're going to take credit risk out of bonds, and you really changed the correlation dynamic for 2 years by what the Fed did to stabilize the markets. It dropped the spread of high yield, for example, to treasuries to historic lows. Because there is still a significant amount of liquidity in the market, which has really not been taken out by the Fed, even though rates went up significantly, there's still a fair amount of liquidity. It doesn't look like that much liquidity has actually been drained. Because of that, and part of that's because there was a very big fiscal blowout, part of that is that the spreads are still quite low. And so because spreads are very low, Mike, anything that would impugn corporate activity, if you did get a drop in S&P or technology earnings, you could be vulnerable to a much bigger drop in these bonds, because these bonds have been bought the last 2 years, 3 years at relatively low spreads.
Yeah.
And that's historically relevant because of where we just came. Hopefully that helps you.
No, it does. It does. I'm like nerding out on this. I like it. It's funny. Like when people see these shows, like, when the final production, like, so, and that's scene that they're seeing you in the screen as an ISO shop, and they should see me in the background. I'm just like processing and analyzing and thinking it through. I love this type of stuff. So to go back to like a little more micro on it, like down to the individual company level, right? Because this is where my brain starts going. Like, okay, so one of the reasons why bonds are typically a hedge against down markets in equities isn't just because, as you said, you get into some yield curve and stuff like that. It's because the fundamental nature, the bonds are less risky than stocks, because in the event that a company goes out of business, they have to pay debtors first before shareholders get their money, right? It's vendors, debtors, and then the shareholders. So just inherently, there's less risk there, right? So in the event that a market is down, the equity market's down, or we're not doing well, or whatever, bond coupons are still being paid, hopefully, unless the market's really in bad shape, right? So inherently, the fundamental value of the debt instrument maintains, right? If we hold it to term, it happens, right? But the equity, all over the place. Where does, on an individual company, where does this kind of like break down? You ever try to get at it?
Well, we saw part of it break down when the pandemic occurred and all the correlations went to one, and there was a real risk of not being able to refinance. I think the point you make with certainly high quality credit is a very reasonable point. But remember, once you get to high yield and you get to, quote unquote junk status, these bonds rarely have the background and the backing to pay off. They really depend on refinancing to get those projects completed. And the name of the game for those issuers is to improve their credit quality to the place where the next refinancing will either get lucky and have lower interest rates and liquidity, or their credit quality will have gone up because they'll have achieved enough of their expectations and their goals that the spread over treasuries will come down. So to a great degree, when we're getting paid additional coupon, much of that is really dependent on the liquidity there in the markets to be able to finance that. And that's still a macro play. That still is the Fed willing to do it. Are foreign buyers still willing to finance U.S. high yield and credit assets? The Japanese have an interesting thing going on right now, which is that they're getting a yield curve. And there's concerns potentially about repatriation. There's some green shoots being seen in stimulus in China. There's some green shoots, although they're probably military shoots being seen in parts of Europe where they're going to spend a lot of money out of budget in order to bring up their share of the defense spending. But that's going to be a fiscal blowout. That's going to require financing. And so these impacts from a liquidity point of view can impact liquidity here. And despite the fact that there are a good amount of corporate bonds that are obviously money good and the cash flows are certainly good enough, there still is an impact to liquidity and the perception around liquidity. And those things are impacted by sales growth. They're impacted by GDP, by the direction of GDP growth and productivity. And as a result, when those impact those top-down issues, they can percolate down and impact not only equity prices, but they can impact fixed income.
I love the fact that you brought up, well, you touched on it, but you brought up the impact of the pandemic, right? This is a shock event. We talk about this, I talk about this a lot with people. Like every once in a while, you have an economic shock event where people can't understand, like, why is inflation so high? Why is it so stubborn? It's like, well, we had this thing called a global pandemic, which shut down global production everywhere, right? And then, but people still wanted to buy stuff, but there was not more stuff being made. And so the old easy definition that I learned back in undergrad, what is inflation? It is too much money chasing too few goods. Pretty simple, right? Right? And so, okay, if I got a lot of money trying to chase the few things that remained, like we had to buy, my son got his driver's license during the pandemic. I had to buy him a car. That used car cost like $5,000 more than it would have under any other circumstances, right?
Of course.
And so, we saw that with housing here in Austin. Like in my neighborhood, house prices doubled within a year or so, like literally doubled. Seems preposterous, right? Well, during the pandemic, very few houses were on the market. And people from other places like California wanted to move to Austin, Texas, where they thought it would be a bigger house, more space, yada, yada, less restrictive environments. So they came to Austin. Those few houses that were on the market could charge whatever they wanted.
Of course.
But once the pandemic left, everybody thinks their house is worth over $1 million. No, the house down the street just a year ago sold for $1 million. Yeah, but the house a year and a half before that sold for $500,000. What is the actual comp here, right? And we see this across the board. Very rarely do people like to lower prices on stuff once they go up. And that doesn't mean not just housing, whatever.
Right.
So you had a shock event. I thought that was really interesting that you brought that up. But the other thing you teed on, I think that is related, or because it was caused by the shock event and then the Fed's response to the shock event of raising rates, right, to try to get a hold on inflation, is many companies never pay off their bonds, right? It's a refinancing. Okay, at some point in time, we'll refinance this whole thing and start the clock all over again. We'll borrow a little bit more money. We'll do some other things, right? We can do that. But what if you can't? Right? What if you can't? What if the rate environment doesn't work?
And, people know that fear.
Yeah.
It doesn't usually occur, but that fear is what creates the Minsky moment. That fear is what creates a lack of liquidity. And, fixed income in the past was a good hedge in those moments. But as we can, your readers, your listeners can look, volatility has never fully recovered down to the very low levels. And when you look at, the performance in the last 2 years, the very solid performance, volatility stayed relatively elevated. And you would say, wait a second, we had some big recoveries. We had some US market exceptionalism, however you want to describe it.
Yeah.
And volatility remained quite high. And what I would say is part of it is because of the issue that you raised, which is it's not clear that the Fed has absolutely given the all clear signal, even though they've eased somewhat. They're not fully easing because there is still some perception of inflation. There's still some perception and inconsistency or lack of clarity around what is the equilibrium in terms of growth, inflation, and Fed policy. And so until that happens, volatility is kind of a valuable asset. Now, most asset allocations, to go back to the concept of what we were talking about, are really simply looking at, equity returns, fixed income returns, with very little in between, and don't really look at volatility as a third factor to manage in portfolios to generate return. And the importance of that is that because volatility is so connected to correlation, if you don't have some kind of a hook into, some kind of an anchor or hook into volatility, you can't actually manage your correlation in a portfolio. So I talk to advisors all the time. It's part of what I do for a living. I love it. They have the toughest job. You all who are out there, you have the toughest job in finance. What I always say is you're fighting with one hand behind your back if you don't have a product. Like we manage a fund, Easterly Hedged Equity Fund, very strong fund. But we manage that fund particularly because it has a hook into volatility so that it overdefends volatility. So when there's a spike in volatility, we basically really offset with that correlation. We downside protect, we correlate. The reason we do that is specifically because if you don't get diversification, if you don't have resiliency in two very major assets, like right now, because they're correlated, you have to provide your clients with some way of diversifying. And without that third leg, that interest into volatility, you have a real problem from a portfolio point of view. And I think it's really obvious to us, it's not just strategic, it's really obvious to us tactically, Mike, that the market has not returned to its 2018 status. Certainly hasn't returned to its 2017 status, where you had that beautiful year and vol was trading on a 4 to 6, S&P volatility. The VIX was almost non-existent and realized was even worse. you have not returned there. And the primary reason is because there's still so much uncertainty. Now, President Trump, for all of the dynamism and expectations and hope that he brings, admittedly self-promoting, but he does bring a plan that does have some dynamism. Even with that, you still see elevated risk, elevated uncertainty. And so we really feel that in this time, because of the issues around diversification and uncertainty around levels of volatility, that it's more important now for advisors to make sure that they have some form of interest in this volatility area, in an area that gives them return, but still has an interest in benefiting from vol. Yeah. And there aren't many products that do that, but it is definitely something that advisors should be doing.
Let's talk about that from keeping it on from the advisor lens, right? Like of how they do this. There's just no scenario in which a financial advisor is going to have one fund in their client's portfolio. Like, hey, I picked a fund for you, right?
Correct.
Here we go. You're welcome. You'll get my fee in the mail, right? That's just not going to happen. Right. So and then obviously every advisor listening or watching will say like, hey, I had this one fund that was supposed to be really cool and kick butt and give my client all the upside and protect them on the downside. And kind of going back to what I said before, until it didn't, until it broke, until it didn't work the way I'd hoped it was going to work. So let's get down to like some more fundamentals of portfolio construction so the advisor can think about it as they're doing this for the clients.
I would say there are two things. Number one, the structure that we use over defends downside. Okay. So that as the market goes down, we're getting a bigger offset. And we reposition on a routine basis, on a 2 to 4 week basis, we're repositioning. Yeah. So we follow the market and we over defend downside and we participate well in upside. And historically, that's been 50 to 60%. In some environments, it can be even higher. And it has been in the last three-year period. But I think the important issue for advisors to understand is our product is designed to allow certain pathways to structurally, because it's options and it's very systematically run, to give a defined response. It's very easy for advisors to go do the work, whether they use Zephyr or Morningstar or whoever, to go find products that defend well in certain kinds of environments. We have advisors who come to us, by the way, and we have a nice sales staff. We have a very solid marketing group and sales staff. But, some people come to us over the transom, Mike, and they say, we did a search on the best downside upside firms. In other words, the firms that give you the best upside against downside, the best ratio in the marketplace. And they look for funds specifically that have very high either Sortino ratios or the best upside downside capture ratios. And they look at those specifically, not because they want to put all their money in them, but because they want to pepper those into their portfolio. And, we do a lot of this analysis for advisors, and there are probably a handful of funds. We're not the only one. Yeah. We certainly do a good job. But, to your point, you can find, if you do research and you say, I want to maximize rather than maximize my Sharpe ratio. And most of the models that advisors use, Mike, are basically backward-looking Sharpe optimizers. So they take the return minus the risk-free rate over your standard deviation of volatility, and they take those and they create a Sharpe ratio, and they maximize to the Sharpe ratio. We would rather do something a little different. If you're really worried about getting returns tight to your forecast, and you think drawdowns are the problem, don't optimize to Sharpe ratio. We would optimize to Sortino ratio, which is instead of looking at that calculus over the standard deviation of return, look at it over the negative, the drawdown standard deviation of returns when there's declines. I call that in essence a comfort index rather than a Sortino index. I call that the comfort index because it means as an advisor, your client's going to have more funds that protect downside. They're going to get a smoother ride. They're still going to get efficient management, but they're going to be focused on making sure that their downside is. And that's certainly better for individuals who are in the market, because if they're really not trying to get the absolute highest return and subject themselves to the lowest returns, they want to get the best long-term ride, they should be optimizing to Sortino. So how do you do that as an advisor? Is you find funds that have high Sortino ratios and you pepper those in, and you look for funds that have the best upside downside capture. And there are many databases that'll give that to you, but that's a great practical way of bringing in 5, 10, 15% of those kind of funds. And what you'll see when the market gets into drawdown, those guys are going to give you that nice protection for your core. So that's the approach we'd espouse.
I got to tell you, one of the things I love about what you just shared there is not only does it remind me of my good buddy Zvi Bodhi, who was just getting a lot of airtime on this podcast, where he's my professor from Boston University. He is the author of Investments, the book Investments that every business school in America pretty much uses. That's Dr. Zvi Bodhi. And he studied under, was it Merton, who one of the authors of the Black-Scholes model and all this. So awesome stuff. One of the things he espouses, and this is not too dissimilar from what you're describing there, is, hey, look, the bulk of your money should be in Treasury inflation protected bonds, right? Like, listen, we're going to get a guaranteed risk-free return with some inflation kicker, and then buy at the money call options, right? Like, so he just has this very basic model. That's kind of how he's like, buy at the money call options on the market. We're going to get all the upside. We're going to have our downside protected. We'll participate with inflation, all that type of stuff. It's an oversimplistic portfolio, but he's been preaching it for years. So give him a shout out. But what really resonates with me with what you're saying, and I think every advisor will probably nod along, is the times your clients call you the most or want to talk to you the most and you need to talk to them the most is when markets are down, right? When, of course, the bleep has hit the fan, as they say. That's everybody's freaking out, right? And if you could come to your client and go, you're good, the market's down this much, the traditional 60-40 portfolio, 70-30 portfolio, whatever is appropriate for your age bracket would be down here. We're only down this much, or we're not even down at all. That's a good thing, right?
Well, I think, yes, conceptually, it is the only thing, because it doesn't matter how a client's account does after he leaves you. It only matters that your clients stay with you.
Great point.
And I would say, even from a business point of view, for advisors, they hire people to do their research. They hire people to do their operations. Yeah. They hire people to do accounting for clients.
Yeah.
They have very high expenses to manage. And so for them, their fees have to cover the management of their business. So if accounts have tremendous variance, have tremendous volatility in the value of their business, their AUM, it affects their ability to be sustainable as a business. Yeah. And so there are a lot of really top advisors. I mean, we have wonderful RIA clients who come to us and say, one of the big reasons we love having a significant allocation to your fund is because we know it's going to be a keel. If we put out a lot of sail and the wind blows, we know your product is going to be there. It's going to give that offset that allows us to drive for return, but at the same time keeps us somewhat stable. So it's really important, not just for clients, because you clearly need to keep them in the market. And by the way, we both know, I know you've quoted these numbers before, that a tremendous majority of the return of the S&P over the years comes in mean reversion periods. In other words, the market's gone down 7-8%, maybe it's full 10% correction. And then the subsequent 6 months, 9 months, you get all that back and more. And if investors aren't complying to their asset allocation, there's a problem. They end up losing over a long period of time returns because they couldn't comply to their asset allocation. And so this is where it's not about fees, Mike. This is the problem that I have, is that the whole passive mentality, whether or not every manager beats their benchmark or not, is a different issue. I think there's a value to cash from a risk management point of view, but I think the focus on fees has allowed clients to not understand risk management and compliance to asset allocation. So for example, in a year where we significantly defend against the S&P drawdown, you don't really care if that you paid 7 basis points or 8 or 9 basis points for an S&P index fund. If we defend significant percentages of the drawdown, you're much more focused on the principal we saved you, on the amount of loss we saved you, than you are the 7 or 8 basis points that you paid for that, because it gave you dollar for dollar risk on the S&P drawdown. And I think that's where managers have to there has to be a pragmatic view of the value of low fees against the value of risk management, against the value of sound asset allocation thinking, against the value of adherence, compliance to asset allocation mandate. And I think when you put that together, it's actually really easy to understand why alternatives are important.
Yeah.
But at the same time, you don't use alternatives that just look good. You need to really screen for alternatives that do the things we just talked about. When the market goes down, does that alternative go down less? And when the market goes down, does that alternative have some kind of an eye into volatility where it makes money because volatility's gone up? Options-based strategies like our Easterly Hedged Equity Fund do that.
Yep.
But we're not the only one. But it's really important to be disciplined in looking at what alternatives actually meet that criteria. They're absolutely available. I'm always welcome to take calls from advisors who are like, what kind of products can we use with you to do that? But I think there is a holy grail that is here, but it's not in modern portfolio theory. Correlations are stable over the long term kind of thinking. It's this really new approach to understanding in granularity what makes portfolios resilient over what makes portfolios basically just follow the market.
Yeah, I love it. I tell you what, you made me think of one thing that I think we all as human beings, and it even goes back to the housing thing, everybody remembers the high water mark. What do I mean by that? Like, if at one point in time, my portfolio, I got a statement in the mail or I opened it up on my phone or my desktop, it said I have $2 million. I am worth $2 million. I will remember that I was worth $2 million, no matter how bad the market does over the next several years. Ask anybody who was in the tech bubble back in the .com, how much they were worth at one point in time on paper. They remember how much they were worth. They remember the high watermark. They will also tell you about, I woke up one day and the stock was worthless of my pets.com or whatever the thing was back in the day, right? So it's really important to keep that in mind. If you're an advisor, your clients they pay attention to that. Like, and again, it goes back to the whole thing, how I said about housing. Nobody's ever going to sell their house for less than they thought it was worth at the peak unless they're forced to. Correct. Type of deal. But as it relates to their portfolio, I think you're spot on. I think the notion of, hey, I want the upside, but what I definitely don't want to do is have any type of protracted downside in my portfolio. I want to try to shallow out those troughs as much as possible so that we can, and again, it's also easier to grow if I went down 2% versus 15%. It's much easier to get back up to high water mark from there than it was from way down below.
That the math of losses is quite compelling.
Yeah. All right. So I know we're kind of at the end of our time here. People are going to want to follow up and learn more. We'll make sure we get the links up to Easterly. You're on LinkedIn. I think you're active there. Where else are you active? Where else can people find and learn more from the great mind of Arnim Holzer?
I'm on Twitter as well at Arnim Holzer, but EAB Investment Group has its own site. Easterly that sponsors the fund that we sub-advise, has quite a good site. I'm also on Bloomberg for any of the institutional folks.
There you go, fancy pants.
Or any of the. And by the way, there are registered investment advisors, RIAs, who do have access and go through Bloomberg as well. And generally, they can also reach us through our PR firm as well. But Easterly is a great way to get this. We love having great conversations. A lot of what we do, Mike, is try to get folks to be functional. We don't think that long-term averages of 3 to 5% against what should really be delivering 7, 8, 9% returns in diversified portfolios is acceptable. And, our goal is to help people, whether they're a low risk client or a high risk client, to really help them achieve more like the forecasted returns and get those things tighter. And so our goal is to really help people do that. So we do a lot of advising, we do a lot of consulting, and obviously we hope people will buy our fund to help in that process. But this mindset, I think, is really important, and we're evangelical for this process. So we love having great conversations.
I love it. You use one of my favorite words, evangelizing the concept. Get out there, thought leadership, shout it from the rooftops type of stuff. So that's why we do these shows. This is wonderful. Well, thank you very much for coming on the show, Arnim.
It's my pleasure, Mike. Thanks so much for having me.
Thank you very much for listening to and/or watching this episode of the Modern Financial Advisor podcast. It's always fantastic to have you with us. Huge props to my man, Arnim Holzer, for coming on the show and sharing all of his global macroeconomic genius stuff. Love it, love it, love it. I feel extra smart after this conversation. If you haven't done so already, as I mentioned at the top of the show, please do subscribe to the Modern Financial Advisor podcast on your favorite podcast platform or over on the YouTubes. That's all I have for you. Hopefully you're having a good day, and be nice to each other. We'll see you next time on the Modern Financial Advisor Podcast. See ya. Bye.